You check your bank account on a random Tuesday afternoon. You weren't expecting anything dramatic, just a quick glance before you buy lunch. But the number is lower than you thought, again. And you do that mental rewind like, wait, I get paid pretty well. Where is it going? You didn't buy anything crazy, no yacht, no Rolex, no luxury vacation, just life. Subscriptions, food, random Amazon orders. A couple I deserve this moments. And then you have this quiet, uncomfortable thought. If I keep going like this, where do I actually end up? Not next month, not next year, I mean 10 years from now. Here's the thing, most people don't have a spending problem. They don't even have an income problem. They have a math problem they've never been shown. My name is Jay, and I spend way too much time thinking about how money flows through people's lives. If you're someone who earns money but still feels behind, still feels like you should be further ahead by now, hit subscribe and give this video a thumbs up. Because today, I'm going to give you a single formula that predicts your financial future with uncomfortable accuracy. And once you see it, you can't unsee it. And yes, it's simple. And no, almost nobody uses it. Now look, most financial advice lives in extremes. Save everything, invest everything, cut out coffee, start a business, buy real estate. That's all tactics. But tactics without a model are like trying to build a house without a blueprint. The formula I'm about to show you is the blueprint. It's called the cash flow formula, not the complicated Wall Street version. The real one, the personal one. Here it is. Your financial future equals income, expenses, times, time, times behavior. That's it. And I know you might be thinking, that's obvious. No, it's obvious after someone explains it, but it's invisible when you're living inside it. Because most people only look at one variable income. They think money problems are solved with raises. But the formula has 4 moving parts. And the sneaky one, the one that quietly decides everything, is behavior. Let me show you what I mean. Let's take 2 people. Both make $60,000 per year. Same city, same age, same starting bank balance, same opportunities. Person A spends $55,000 per year. Person B spends $45,000 per year. That's a $10,000 difference in annual cash flow. Now here's where it gets interesting. If both invest their surplus at 7% average annual return, which is roughly the historical long-term stock market average according to multiple S&P market studies after 20 years, person A ends up with about $204,000. Person B ends up with about $409,000. Same income, same market, same time, double the wealth purely from cash flow spread. That's not a hustle difference. That's not a talent difference. That's a behavioral difference. And this is where most people don't realize something critical. Your financial future is less like a lottery ticket and more like a thermostat. Small adjustments repeated change the climate. Now let's talk psychology, because math alone doesn't change behavior. Roughly 70% of Americans report money as a significant source of stress. But here's the paradox. Stress does not automatically produce better money decisions. It often produces worse ones. Stress spending, comfort spending, avoidance, denial. Future me will handle it. Behavior under emotion breaks math. That's why 2 people with identical spreadsheets get different outcomes. Let me give you a metaphor. Think of your financial life like a bathtub. Income is the faucet. Expenses are the drain. Investments are the water pressure multiplier. Most people obsess over turning the faucet higher, more income, while ignoring the fact that the drain is wide open and leaking. And some people try to invest aggressively while the drain is still open, which is like pouring water into a tub with the plug missing. Now, you might be thinking, okay, but I can't just slash my expenses. Life is expensive. Correct. This is where nuance matters. The formula is not about deprivation. It's about direction. Because there are only 3 ways to change your financial trajectory. Increase income, decrease expenses, improve behavior consistency. That's it, no hidden 4th lever. But behavior consistency is the multiplier most people ignore. Let me show you something surprising. Average investor returns underperform the funds they invest in by about 1.52% per year purely due to behavior. Buying high, selling low, panicking, timing attempts, That behavior gap can cost more than bad investments, meaning the person with the worst strategy but better behavior often wins. Now let's build your predictive model. I want you to calculate this. Monthly net cash flow equals monthly income, monthly expenses. Not guesses, real numbers, after tax, after auto pay, after subscriptions. Let's say it's $600. If you invest $600 per month at 7% for 25 years, that becomes roughly $455,000. Same $600 spent instead? Zero. Same income, different behavior, $500,000 swing. Here's what most people don't realize. Your savings rate matters more than your investment return early on. If you save 5% of income and earn 12%, you still lose to someone saving 20% at 7% for the first decade plus. Because contribution beats optimization at the beginning. Now look, I know the objection coming. Jay, this works if you already have margin. I don't. Fair. So let's talk margin creation. There are two types. Visible margin cutting, obvious waste. Invisible margin fixing, behavioral leaks. Invisible leaks are things like impulse upgrades, lifestyle creep after raises, emotional purchases, convenience premiums, subscription drift. The average American spends over $200 per month on subscriptions, according to multiple consumer finance trackers, and most people underestimate theirs by about 40%, because small recurring expenses are psychologically invisible. Behavioral economists call this frictionless spending. No pain, no memory, no resistance. So here's an immediate behavioral hack. Introduce friction. 24-hour delay rules, manual purchase confirmations, separate spending accounts, remove stored cards from shopping apps. You're not restricting, you're inserting awareness. Awareness changes behavior. Behavior changes cash flow. Cash flow changes destiny. Now let's layer time into the formula, because time is where this gets unfair. Compound growth is brutally backloaded, meaning the last 10 years of a 30-year investment period often produce more growth than the first 20 combined. Example, invest $500 per month at 7%. After 10 years, about $86,000. After 20 years, about $260,000. After 30 years, about $610,000. The final decade adds more than the first 2 decades combined. This is why consistency beats intensity. People try sprint strategies in a marathon system, crash budgets, extreme cuts, unsustainable side hustles, then burnout, then relapse. Financial success is boring on purpose. Now here's the part that predicts your future with scary accuracy. Track just 3 numbers monthly for 6 months. Net cash flow, savings rate, behavior consistency score. Yes, score yourself. Out of 10, how well did you follow your own rules? Because self-rating increases adherence, this is documented in habit tracking research across behavioral psychology. Patterns emerge fast. 6 months of behavior predicts 6 years of outcome, because habits stabilize. Now, you might be thinking, what about investing strategy, asset allocation, market timing? Important but secondary, because strategy without surplus is theory. Cash flow funds strategy. Let me give you a story. 2 friends both start investing. One waits until he understands everything. The other auto invests 15% immediately into a broad index fund and keeps learning. 10 years later, the learner has knowledge. The doer has money. Action compounds, hesitation doesn't. Here's another psychological truth most people don't like hearing. Your lifestyle expands to match your identity, not your income. If you see yourself as bad with money, your behavior will prove it. Identity drives consistency more than goals do. So flip the identity. I am someone who creates margin, not saves. Creates. Creation feels powerful. Saving feels restrictive. Language changes compliance. Now let's make this actionable. Starting this week, automate investing the day after your paycheck hits. Calculate your real monthly cash flow. Add purchase friction rules. Track behavior monthly. Increase savings rate by 1% every quarter. Not 10%. 1. Tiny levers moved repeatedly beat giant levers moved once. And here's the motivational truth I want you to hear clearly. You are not behind because you didn't know enough. You're behind because no one showed you the formula, but now you have it. Income minus expenses multiplied by time directed by behavior. That predicts your financial future. Not luck, not talent, not genius. Behavior. And behavior is trainable, which means your future is adjustable. Start adjusting today.